In this video, I'll discuss how you can invest in foreign securities. There are a variety of ways that you can invest outside of the United States. We've already discussed the New York Stock Exchange and the NASDAQ in this course, but these are by no means the only stock markets on Earth. Outside of the United States, we have the London Stock Exchange, the Tokyo Stock Exchange, the Shanghai Stock Exchange, the Hong Kong Stock Exchange, the Tadawul, the Botswana Stock Exchange, and many others. Each of these allows investors to buy and sell stocks and other assets. So if you can invest in securities in these markets, one reasonable question should be asked: why would you want to invest in these markets? The primary benefit of international investment is that it increases the diversification of your portfolio. Remember, portfolio diversification is one of the best ways to reduce the risk of your portfolio. Investing internationally allows you to diversify by holding a wider array of securities, so there's a greater probability that you can find a mispriced security. International diversification also allows you to break into and become exposed to securities in a new market that you otherwise could not have invested in. Finally, investing in international securities allows you to profit from fluctuations in the value of currencies. Now let's talk about how to increase your international exposure. A very simple way to do this is to invest in shares of multinational firms. Multinational firms are firms that have operations both within the US and outside of the US. For example, if we look at Coca-Cola's annual report, or 10K, we can see that the firm has operations and sales in more than 100 countries. As I scroll down, this is Coca-Cola's 10K. And if we look into it, we can see that Coca-Cola has sales in more than 200 countries. Factors that affect consumers in each of those countries will affect Coke's sales and operations. The next way to purchase shares of a foreign security is to go directly to the foreign stock exchange where those shares trade and purchase those shares. For example, let's say you want to purchase shares of a security listed on the Botswana Stock Exchange. Well, the first thing you're going to do is you're going to go to the Botswana Stock Exchange's website. You're going to identify brokers that buy and sell shares, and you're going to hire a broker. You're going to have to meet some conditions in order to trade on the Botswana Stock Exchange. For example, there might be some information that you have to provide in order to become an investor on that exchange. One drawback to investing in foreign stock exchanges is that they often come with extremely high fees relative to the US market. Now, the next way that you can diversify internationally is by purchasing what are called ADRs, or American Depository Receipts. These are dollar-denominated receipts for stocks of foreign companies. They're issued by financial institutions in the United States. So what does this mean? Well, let's say we have a company like Alibaba. Alibaba is often referred to as the Chinese version of Amazon.com. The firm's shares trade primarily on the Hong Kong Stock Exchange. However, the firm's shares are also cross-listed on the New York Stock Exchange. You can buy one share of Alibaba's ADR, which entitles you to 8 shares of the stock listed in Hong Kong. This is done when a financial institution purchases shares on the firm's primary stock exchange, aka the Hong Kong Stock Exchange, and then allows U.S. investors to buy securities that are tied to those foreign shares. The shares of stock listing on the Hong Kong Stock Exchange are referred to as American Depository Shares, while the ADR shares trade in the United States. If you buy an ADR share of Alibaba, this one share is backed by 8 shares listed on the Hong Kong Stock Exchange. Now, the final way that you can invest internationally is by purchasing shares of an international stock that is directly listed in the US. This is less common than companies having ADRs on the US markets, but it does occasionally happen. Usually these are companies that are headquartered in Canada. Now, you might be wondering why a foreign firm's shares would be listed directly or via an ADR in the US or some country outside of its home country. The answer is simple. There are many investors in the U.S. that want to purchase shares of foreign stocks. This demand is good for the current owners of the firm's shares, since demand by foreign investors can increase the price per share of the firm's stock. When you invest in foreign securities, you should know that there are many risks associated with doing so. Obviously, any risk that would be present when investing in the United States will still exist when you invest internationally. However, when you invest internationally, you also have to consider political risk. And political risk is the risk of changes in the political or regulatory situation of a country. Political risk is much more common in countries where the rule of law, aka everyone is subject to the same laws, is weaker. Countries where bribery, extortion, and other corrupt practices are more common exhibit more political risk. Political risk also involves the risk that a change in the law affects the value of the security you're investing in. For example, let's say you've invested in shares of a telecommunications firm that has a monopoly on cell phones in a country. After you invest in these shares, the country where the firm operates announces that it will change the law to allow competitors to enter the market and provide cell phone service. As soon as that announcement is made, the value of your shares is likely to fall. Another example of political risk is the risk of nationalization. Nationalization occurs when a country takes control of the assets of a firm. This happens in countries where the rule of law is weak. An example of this occurred in March of 1951, when the parliament of the country of Iran voted to nationalize the country's oil industry. When this legislation was passed, all assets of the Anglo-Persian Oil Company inside Iran ceased belonging to Anglo-Persian. You're certainly familiar with this firm. Today it's known as British Petroleum, or BP. Usually firms whose assets have been nationalized have some recourse in U.S. federal court. The final risk you're exposed to outside of the U.S. is currency exchange risk, or exchange rate risk. This is the risk that during the investment period, changes in exchange rates will adversely affect your investment. Let me give you an example. Let's say that you invested in 100 shares of Carrefour, a French grocery store. Now, Carrefour shares are denominated in euros because the country is headquartered in France. So, let's say that you buy 100 shares of Carrefour, and at the time you buy them on January 1st, the shares are trading for 15 euros per share. The exchange rate on the day that you buy these shares is 1.1 euros per US dollar, as you see here. So in other words, each euro buys $1.1. Now, since you paid 15 euros, and you had to buy those euros by exchanging your dollars for euros, and you bought 100 shares, the price you paid in euros is going to be $1,650. Now, let's say that on July 1st, those shares are worth 20 euros per share. In other words, they've appreciated in value by 33%. So now you want to sell them for a profit. However, the exchange rate on July 1st has fallen. In other words, the value of euros relative to dollars has fallen to 0.8 euros per US dollar. This means that although the value of your investment in euros has risen, the value of the euro relative to the dollar has fallen, and therefore once you sell your shares for 20 euros per share and convert those shares, or the price you received by selling those shares, back into dollars, you will have 100 shares times 20 euros times 0.8 euros per dollar, or $1,600. In other words, your return was the price or value that you had at the end of the period minus the value that you had at the beginning of the period, all divided by the price or value that you had at the beginning of the period, or negative 3.03%. In other words, even though the value of those international shares increased in value, a decline in the exchange rate over the investing period led you to lose value on your investment. And with that, I'll wrap up. If you have any questions about this material, please feel free to ask me either in class or via email or phone. I look forward to talking to you in our next class. Thank you very much.